Hello guys, we are we are back testing GBP USD. Now I have changed my strategy. Before I was trading the LXG set and forget strategy, right? So now I am trading an entry model that is based on the Asian range. Whatever the Asian session does, according to that, we decide what we want to do with higher time frame bias. Higher time frame is the most important thing in this strategy. As you can see in the weekly time frame, when we have a quick overlook of the market was trending down, making lower highs and lower lows. Here it changed character to the upside, making higher highs, higher lows, higher highs, higher lows, higher highs. Here we can clearly see the market's bullish. You probably the charts will be looking very messy, but I understand this because I've been doing this for a while now. In the weekly time frame, we can see whatever happens here, right? Whatever happened before, like months ago, it's irrelevant in the strategy. This is a day trading strategy, so the closest price action is the most important thing. We have to keep a watch on that. Here we can see in the weekly time frame, the price is making higher highs, higher lows, higher highs. So we know that the price makes higher highs and higher lows when it's trending bullish, right? So here, the moment it broke structure to the upside, we can mark this zone as a break of structure in the weekly time frame. And here there was a beautiful weekly fair value gap. Here we can spot the gap between this wick here and this wick here, between the gap between the third and the first candle, between the wicks, the bottom wick of the up candle and the top wick of the down candle. This gap is called the fair value gap. No need to overcomplicate this. Fair value gaps are just gaps formed in the market due to aggressive buying or selling. Here we can see the week before previous week was a bearish week, right? After that, the next week continued with it and continued to trend to the downside. Here we can also spot that it was a bullish pin bar, and we know that whenever this bullish pin bar candle, huge wick to the downside forms, that means that the price went down, but the buyers came in the market, took all the pressure and took the price to the upside again, making a bullish pin bar. So whenever this candle forms, the higher the time frames, the better. It is a sign that the market is now, the buyers are getting in the market. That's what it's saying. And it has also filled up the fair value gap, and it has also made a pullback. As we know, the market, when it's bullish, it cannot go up forever. It has to make higher highs and higher lows. So after the higher high leg, it made the higher low leg here, rejected this fair value gap, made a bullish pin bar. There are so many confluences coming together telling us that it is making more sense to go upside. So our weekly bias is bullish. So after seeing this, my weekly bias was bullish. So now we go to the daily time frame. In the daily time frame, if we zoom out the price, the trend is clearly towards the upside. It is heading towards the upside. Then I draw the fib retracement tool from this low here, from this swing low to this swing high, to know if the retracement is valid or not, something like this. And when I draw this, we can spot that the retracement happened exactly to the equilibrium level. This 0.5 to 0.618 level is called the equilibrium level, and below this, when the price goes below this is called the discounted level. We always want to buy or sell when the price has retraced at least at the discounted level, at the equilibrium level, or the discounted level. We can see also there's one more confluence telling us that the market can now go to the upside. And also in this strategy, to decide our daily bias, we look at the previous candles price action, right? So it was making higher highs and higher lows. The huge pullback happened here last week. Monday was a indecision candle, Tuesday was bullish, Wednesday was bearish, Thursday was bearish, Friday literally gave a bullish engulfing candlestick, engulfing the previous candle. this body engulfed the previous body candle, and after a candle like this, it doesn't make sense to go all the way down there. Like after Friday closes like this, it doesn't make sense for Monday to open like this, right? So what we will do here is, obviously we don't trade Mondays. To be honest, I'm backtesting to figure out if I will trade Mondays or not, but Mondays are always going to be tricky because we don't know what the rest of the week can be up to, right? If we wait for Monday to play out, then we can have a very good idea of what the overall week is up to, and we can make decisions based on that. Whereas right now, if we are bullish, my bias was bullish, right? So if my bias is bullish, the most probable situation here will be to respect the previous weekly low, to respect the previous weekly low and take out the previous weekly high. 9 out of 10 times a market will take out the previous week high or low. It is very certain. 9 out of 8 times it does that. And if our bias is bullish, the most ideal case scenario will be the previous weekly low will get respected and then the previous week high will be taken. So we have to wait for the timing to get our trade within those zones. It can be Monday, Tuesday, Wednesday, doesn't matter. we just have to be able to take the most high probability setup right here throughout the week, and after that the next. And if we are bullish in the weekly time frame, as I've shown you, our next target will be this draw of liquidity, which got hit perfectly. Our analysis got exactly perfected, but this week this is backtesting. So backtesting, we can see the candles even before they happen, so it's not the best, but to know your setup and to practice what you've learned is the best thing you can do. Now, as our daily bias is bullish, weekly bias is bullish, Monday we are looking for buys. Then we go to the 4-hour time frame. In the 4-hour time frame, we can see, we always zoom out. While zooming out, we can see it was following an uptrend. Now it's in the pullback phase, making a higher low. So after the higher low, if it's bullish, it will make a higher high, right? So we want to be part of the higher high. And now it's becoming clearer and clearer. As you can see, the previous week high is here, previous week low is there, previous daily low, previous daily high. These are very strong liquidity points in the market. These are zones where people bought and sold in large numbers. That's why we mark these zones. And also the 4-hour change character to the upside right here. There's also a 4-hour fair value gap. We are looking for buys. So now our higher time frame analysis is done. So now we go to the 1-hour time frame, and this is the Asian range right here. This yellow thing right here is the Asian range. The Asian range above and below has huge liquidity. There's huge liquidity above the Asian range and below the Asian range. So we use that in our advantage to take the trade. Here the Asian low got swept. At first we got induced. I'll show you how. At first I got induced, and then at the second trade we were break even. So this was a losing trade if I had taken it, but it was Monday, so I would probably not take it in a live markets, but it is what it is. While backtesting, we have to see all the possible case scenarios, right, and learn from it. So there were two demands. One demand was on this one hourly previous bearish candle. The demand, we marked this demand as a strong demand zone because this caused this change of character in the 1-hour time frame, and that is one demand. But we also have to be very reactive, like we have to adapt to the conditions of the market. Look, for me it didn't make sense to go all the way down there and come all the way up here because of the volume of the market and how far it is. And if the market were to go there, it made sense to go and take the previous week low and continue to the downside, right? So that demand zone is not that it's strong, but it's not that certain for me. So I have marked another demand right here on the 15 minutes. I got a beautiful demand right here, not one of the strongest, but yeah, the market can make it move from any demand or any supply. So we have to, we as traders, we have to adapt to the market, right? At first the Asian low got swept, we got a rejection candlestick on the 15 minutes time frame. That is what we exactly look for every single day. but this trade was not a high probability because look at the timing. It happened on 11:45, which is pre-London, and pre-London most probably is the time where the inducement happens and we don't get the trades. Like we get, most of the times it's an inducement, right? So that happened. This first position of mine got induced, and after that it came all the way back to the demand zone, and it was, the first position was from the 1 hourly fair value gap, as you can see here, H1 fair value gap. Also the move from the supply or demand zones are much stronger than the fair value gap, because the fair value gaps are the result of the move that happens in the market, right? The aggressive moves. But the supply and demand zones are the cause of the move. Like the move happened from that zone which created the supply and demand, which was created by the supply and demand, which we mark as an order block called supply or demand. But the fair value gap is the result of the move, so the supply and demand zone is stronger in this case. So also inducement makes the move even stronger. As you can see, the market induced huge selling pressure here. We got a bullish pin bar. Exactly, we always want to see this candle in the market before taking a trade. Let me show you this candle right here. After that we got huge bullish pressure, and the market literally did nothing. It consolidated, took me out at break even, and then eventually this was a winning trade. But as our rules, I would have already break even the trade, so it is a break even trade. And the last thing is, we also compare it to DXY, right? We took that trade on 1:30 p.m. which is London Open, right there. And in DXY we can see the Asian high was swept. The Asian high got swept, the price went up to this fair value gap, M15 fair value gap. This whole zone was a 1 hourly fair value gap. You can see this whole zone was a 1 hourly fair value gap, filled up most of it, and after filling up most of it, the price got enough liquidity, enough orders to make a down move. This is done by the big banks so that it can take all the liquidity from the retail traders and then make the move towards their direction. So we have to be able to trade with the big banks. That's what we want to do. And this is our first trade. This was a break-even trade. If I hold it, it was a winner, but for now it's a break-even trade. And yeah, this strategy is looking nice until now. Catch you in another video.